Charlie Munger once said that the first $100,000 is a real challenge to accumulate. And you know what? He was absolutely right. But what nobody tells you is that there's a specific reason why it's so difficult, and more importantly, there's a proven strategy to actually get there. Today, I'm walking you through the complete roadmap from $0 to $100,000 in net worth. Not theory. Not wishful thinking. Real numbers, real timelines, and real strategies that actually work. So why is the first 100,000 the hardest? It's pretty simple math, actually. When you're starting from zero, you're doing all the heavy lifting. Every single dollar in your net worth is a dollar you personally earned and saved. There's no compound interest helping you yet. No investment returns doing the work while you sleep. It's just you grinding it out. But here's where it gets interesting. Once you hit that 100,000 mark, the game completely changes. That 100,000 starts generating its own returns. At a 7% annual return, that's $7,000 your money makes for you in a single year. And the next year, you're earning returns on 107,000. Then 114,000. The snowball effect kicks in, and suddenly the second 100,000 takes half the time of the first. That's why getting to that first 100,000 is so critical. It's not just about the money. It's about crossing the threshold where your wealth starts building itself. Let's break down the actual journey. I'm gonna give you 4 distinct phases, and I want you to figure out where you are right now so you know exactly what to focus on next. Phase 1 is the stabilization phase. This is where you need to spend your first 6 to 12 months. If you're carrying high interest debt, if you don't have any emergency savings, if you're living paycheck to paycheck, this is your starting point. Your first goal is to save $1,000. Just $1,000. This is your starter emergency fund. It's not meant to cover 6 months of expenses. It's meant to keep you from going further into debt when your car needs a repair or your laptop breaks. This $1,000 is your shield against Murphy's Law. At the same time, you need to attack any credit card debt like your financial life depends on it, because honestly it does. If you're paying 18% interest on credit cards while trying to build wealth, you're running on a treadmill. You might be moving, but you're not going anywhere. Here's a realistic target for this phase. If you can dedicate $300 to $500 per month toward your emergency fund and debt elimination, you can get through this phase in about 8 to 10 months. It's not glamorous. It's not exciting, but it's absolutely necessary. Now, while you're doing this, you also need to look at your income, because here's a hard truth. You cannot reasonably build a $100,000 net worth in a few years on $30,000 a year. The math just doesn't work. So during this stabilization phase, you need to be thinking about how to increase your earning power. Can you get certified in something? Can you learn a skill that pays more? Can you switch to a company that pays better? Can you start a side hustle? These are the questions you should be asking yourself every single day during this phase. Once you've stabilized, you move into phase 2, the acceleration phase. This is where you're going to spend the bulk of your time, probably 2 to 3 years. This is where the real wealth building happens. Your mission in this phase is straightforward. Maximize your savings rate and invest consistently. You want to be saving and investing at least 20 to 30% of your gross income. I know that sounds like a lot, and it is, but that's exactly why most people never build significant wealth. They're not willing to make the sacrifices required. Let's run some actual numbers. If you're making $50,000 a year and you save 25% of that, you're putting away $12,500 annually. That's about $1,040 per month. If you invest this consistently in a diversified portfolio averaging 7% returns, you'll hit $100,000 in about 6 years. But what if you could bump your income to $60,000 and maintain that savings rate? Now you're saving $15,000 per year, $1,250 per month. Your timeline drops to about 5 years. Push your income to $70,000, you're looking at closer to 4 years. This is why I'm obsessed with the dual approach. Cut expenses and increase income simultaneously. Most people think it's one or the other. The wealthy know it's both. On the expense side, focus on your big 3: housing, transportation, and food. These 3 categories eat up 60 to 70% of most people's budgets. Even small optimizations here create massive results. Getting a roommate and cutting rent by $500? That's $6,000 a year toward your $100,000. Driving a reliable 10-year-old car instead of financing a new one? That could be another $400 a month, almost $5,000 per year. But again, cutting expenses has a ceiling. You can only cut so much before you're miserable. Income has no ceiling. This is why the acceleration phase needs to include serious focus on earning more money. In today's economy, you have options your parents never had. You can freelance online. You can build a service business with almost no startup costs. You can create digital products. You can consult in your area of expertise. You can learn high-income skills like sales, marketing, or coding. Pick one path and commit to it for at least 6 months. Don't jump around. Don't chase shiny objects. Master one income stream. Get it generating an extra $500 to $2,000 per month. Then decide if you want to scale it or add another stream. Every extra dollar you earn needs to go straight to your wealth building goals. This is where most people fail. They get a raise or start earning extra income and their lifestyle expands to match it. New car, nicer apartment, more eating out, and they wonder why their net worth barely moves. Fight lifestyle inflation like it's your enemy, because it is. Your future self will thank you. Now let's talk about where that money actually goes. The investment side of this equation. This is where a lot of people get paralyzed because they overthink it. They think they need to find the perfect stock or the perfect crypto or the perfect real estate deal. They watch videos about day trading and options and alternative investments. For your first 100,000, keep it simple. Boring is beautiful in investing. Here's the priority order. First, if your employer offers a $401,000 match, contribute enough to get the full match. That's an instant 100% return. Free money. Take it. Second, open and max out a Roth IRA if you're eligible. That's $6,500 per year as of 2020-23, potentially more depending on the current limits. This grows tax-free, which is incredibly powerful. Third, go back and contribute more to your $401,000 beyond the match. Fourth, if you've maxed those out, invest in a regular taxable brokerage account. As for what to invest in, keep it simple. Low-cost index funds. An S&P 500 index fund gives you exposure to the 500 largest companies in America. A total stock market index fund gives you even broader diversification. These aren't sexy. They won't make you feel like a genius stock picker, but they work. The returns over the long term average around 7 to 10% annually. Some years you'll be up 20%. Some years you'll be down 10%. You don't care about the short-term noise. You care about consistently putting money in month after month, year after year. This consistency is everything. It doesn't matter if the market is at all-time highs or if it's crashing. You invest the same amount every single month. This is called dollar cost averaging, and it removes emotion from the equation. Phase 3 is what I call the compounding phase. This kicks in somewhere around the $60,000 to $70,000 mark. This is where you start really feeling the momentum. Your investments are generating thousands of dollars in returns each year, even if the market is just doing average things. You're not just building wealth through your contributions anymore. Your money is working for you. This is also where your habits are locked in. You're not relying on willpower or motivation anymore. Saving and investing has become automatic. It's just what you do. And psychologically, this phase feels completely different from the early days. You can see the finish line. You know you're going to hit that 100,000. It's not a question of if anymore. It's just a matter of when. The final push from 80,000 to 100,000 often happens faster than you expect. Between your consistent contributions and market returns, you might cover that last 20,000 in less than a year. Now, let me give you a realistic example so you can see how this actually plays out. Let's say you're 26 years old, making $48,000 a year. You spend 1 year in the stabilization phase, clearing out $5,000 in credit card debt and building a small emergency fund. Then you enter the acceleration phase. You're saving 25% of your income, which is about $1,000 per month. You also focus on increasing your income by at least 10% per year through raises, job switches, or side income. Year 1, your income is $48,000. You invest $12,000. Year 2, your income hits $53,000. You invest $13,200. Year 3, income is $58,000. You invest $14,500. You keep this up, and by year 4 or 5, you cross $100,000 in net worth. You're now 30 or 31 years old with a 6-figure net worth. You're ahead of 90% of people your age. But here's what's even better. The journey taught you everything. You learned discipline. You learned delayed gratification. You learned that you're capable of way more than you thought. And now you have momentum. Unstoppable momentum. The first 100,000 proves to yourself that you can build wealth. The second 100,000 comes faster. The third even faster. This is how millionaires are made. Not through lottery tickets or viral videos or get-rich-quick schemes. Through consistent, disciplined action over